Well, good afternoon, everybody. And I've been spared having to make the introductions because they've just been done, which is good because we have only got 30 minutes to get through all the private markets, which is a tough one. But we'll do our best. But specifically, what we're being asked about here is with the rise of private markets, particularly as we've seen in the past 10 years. And then coupling that with what we are seeing in financial markets now, the increased uncertainty, should we be rethinking diversification strategies? And so that's what we're sort of going to try and address somewhat today. But if I could just sort of tee it off a little bit. I mean, diversification is perhaps the most enduring and fundamental principle of investing. I think we're all aware of that, but that has developed significantly over time. And as it applies to private markets, I think it is very clear all the evidence points to the fact that private markets have added greatly to portfolios in offering diversification, but also offering increased returns, reducing correlation, and reducing volatility in portfolios. So if we're answering this question, should we be rethinking diversification strategies? The answer is, well, yeah, everyone should be putting more into private markets, would perhaps be the easiest answer to make. But let's sort of delve into that a little bit more. But a bit of sort of background here. The private markets over the past decade, and by private markets, what we're really talking about here is private equity, private credit, real estate, infrastructure, venture capital. It's doubled in 10 years. So there's about $16 trillion of assets in private market funds around the world at the moment, doubled in the past 10 years. Traditional thinking about diversification was a 60-40 portfolio. But actually, if you'd added 20% of private markets to that portfolio over the past 10 years, you would have added at least 100 basis points to your return. You'd have reduced volatility enormously, and you'd opened up an opportunity set that just otherwise you wouldn't be able to access. And I think it's remarkable, particularly when we think about the equity markets, that here in Europe, or perhaps in continental Europe, 96% of European companies which have got revenues in excess of $100 million are not listed. So unless you're going to private markets, you're not going to get any opportunity to invest in those. So that's kind of sort of the background. I think the other things I would add is that only last week here in the UK, you've had our Chancellor here, Rachel Reeves, announcing an accord that she's set up with 17 of the largest pension plans here in the UK to, within the next 5 years, invest at least 10% of their default defined contribution funds in private markets, from close to zero at the moment. Meanwhile, over in the US, you've got a mad-long rush as private market asset managers form strategic distribution partnerships to sell private markets into retail. And retail have got almost no exposure to private markets at the moment. So certainly there's some thinking there about more diversification required at the investor level as well. Right, let's pick this apart a bit because private market. I'm going to start with private equity, which is the biggest segment. And again, that's your major area of focus. So really the sort of question I want to put to you, and it came out when we had our sort of prep call, I think we recognize, certainly for those of us who read the FT and some of the other media, that more recently, after a golden period in private equity, there's some questions being asked about it, whether that can continue. And maybe that's driven by slower distributions from private equity markets, question marks over valuation, a stagnated IPO market. Tell us how kind of where you think the state of the private equity market is at the moment, so people are reviewing their private their portfolio allocation can think about this in an up-to-date way.
Absolutely. I mean, there's a lot that we could cover, so I'll try to be fairly brief. But clearly, we've been in an environment whereby exits have been less frequent than what we've seen in previous years, and I think part of the reasons for that, you sort of take a step back. It's partly driven by the exit environment, but also the fact that private equity portfolios have gone through a period of dislocation. we've gone through COVID, we've gone through Russia, Ukraine, we've gone through cost inflation increases. So clearly private equity firms are spending more time on their existing portfolios, but also the exit environment. If you sort of have a think about what an exit looks like for a private equity portfolio company, it's either a listing. So the public markets have obviously been extremely volatile, very difficult to price on, and generally have sort of struggled with liquidity in a number of cases. Strategics have not really maybe had the confidence to be as acquisitive as they have done in some 5-10 years gone by. And then it comes to sort of the sponsor side of the market. And that, I think, is an area where, we should spend some time on, because the sponsor-to-sponsor market, the secondary buyout market, has become increasingly prominent, not just in terms of more traditional transactions, but also the GP-led side of the equation. I would just highlight that the majority of dry powder in private equity is in the global or large market segment. And that dry powder has an average weighting of around sort of 3 to 4 years, as in these firms need to deploy over the next 3 to 4 years. Now, what that means is there's a lot of dry powder in the very largest names that need to transact. What that also means is there's a super attractive segment, the small to middle market, that is able to sell into that market, and we think for high valuation. So on your question on exits, I think for the large global segment, it will probably remain more difficult. Clearly, the public markets are not, the most straightforward markets to exit into. But for those small and mid-market firms selling into the large and global segment, there is a super attractive market. So I would sort of disaggregate the private equity market in terms of size over the next few years.
Yeah, I think that's good advice, which you'll probably find as we go through this, is that making sweeping generalizations about the broad asset class is probably not the best way of looking at it. You've got to just delve a bit deeper. And actually, that brings me on to you, Suzana, as we talk about private credit. Now, 10 years ago, there was very limited sort of familiarity with actually what private credit is. And in 10 years, it's grown to whatever size you want to call it. Let's call it a 3 trillion sort of asset class at the moment. Some would say it's bigger. But within that, that's changed very much as well. But it is the new shiny thing that everyone's talking about. But when people start talking about it, they start thinking, well, where are the risks in that? So let's just go through that. I think you quite neatly put it when we were speaking earlier. You talked about private credit 1.0 10 years ago. Now we're in private credit 2.0. Can you just talk us a little bit about kind of what that evolution has meant and what is it now compared to what it was?
Yeah. So if I think about private credit, as you said, 10 years ago, it was very much kind of private credit equals direct lending, very much mid-markets, both sponsor-driven, corporate acquisition finance lending, very niche at that point in time. And over the last years, the asset class has grown massively, not only in size, but also into different products. So if you just think about in 2020, private credit was around 1 trillion in terms of size. We are now around 2.5 between 3 trillion, depends on the way you look at it, expecting to grow another trillion in the next couple of years. So clearly we are onto something. So we moved from the kind of niche direct lending position into now, having private credit in different products, meaning, it's direct lending, obviously, it's mid-market lending, it's opportunistic lending, capital solutions, real estate, infrastructure, ABF, you name it. So it really now goes into the real economy and moves more and more away from the M&A pipeline, which is still a big part of private credit. But if you look at the other products, some of these are double the size. If you look at ABF, the growth opportunity is probably double the size of the PE sponsored market. So we're talking big numbers here, and it's now, as you pointed out, I look at this as private credit 2.0 because the managers have gotten much more sophisticated, the LPs as well. So what we see from the LP side is that LPs are looking to now kind of diversify within their private credit allocation into multiple products. So, you know, you can mix between, as I said, opportunistic credit, real estate, infra, and so on, to diversify your allocation and potentially enhance your future returns.
So I think the takeaway I get for that, to kind of get the most diversification just within private credit, kind of a multi-strategy approach, which I'm assuming that you do,
Yes.
is one way that investors can think about it, rather than just sort of a private credit stream. They've really got to understand what they're in, but a multi-strategy approach from a manager gets you that.
That's exactly what we're seeing with LPs demanding to have this flexibility to allocate really across the private credit spectrum.
Great. So Brandon, that kind of leads me on to you, and we just heard there a little bit about kind of real estate lending as part of a diverse private credit strategy and infrastructure lending. I want to talk to you about real assets in general. I know you, in your role as the Deputy CIO there, you look at everything in private markets, but let's just focus on real assets just to begin with. And I think one of the things you said to me is that you know, these are truly uncorrelated strategies, and therefore they're absolutely vital in the sort of building blocks of sort of portfolio construction. Can you talk to us a bit about that and really sort of explain, you know, or prove to us that there really is uncorrelated as they're made out to be? Yes, I suppose real estate is correlated to inflation to a certain extent, but to other markets. Talk to us about the benefits of real assets within a diversified portfolio.
Happy to, and maybe taking one step back before we do that. You talked about the 60-40 as being sort of a traditional balanced portfolio. Well, I'd probably argue that across Europe, it's probably been more 40-60 or 30-70 because of the income-oriented nature of the portfolios here, which I think is actually one reason why private credit has exploded both globally, but certainly here in continental Europe. And so when you think about trying to diversify income streams, because that is what a lot of European investors are looking into, you say, okay, what is uncorrelated to investment grade? What is uncorrelated to high yield? What is now uncorrelated to private credit? And you think about which asset classes you can go into. Transportation or infrastructure is actually one of those, and it's statistical, you know, at the end of the day, because private credit, for example, the statistics show that it's a roughly 70% correlated to public equity markets, which is roughly the same as public high yield, right? So they move roughly in lockstep, whereas core infrastructure, core transportation, they are at zero. And actually transportation is slightly negative. And you think about, okay, well, am I giving up something, right? If you're entering into long-term contracts, which is what generally core transportation is as an asset class, this is going to be shipping, it's rail car leasing. This is going to be, you know, bus networks in Denmark, et cetera. And you've got government contracts, or you have single A or double A contracts for leasing for 10 to 15 years, you've essentially converted an asset that you put equity into it, but have converted it to an 8.5%, 9% yield, which is like high yield, but you're doing it at zero correlation to any other income stream that you can have in your portfolio, right? And it's locked in. So we happen to actually manage a portfolio that does that, and we see this every single day in our portfolio. And it's very similar with core infrastructure. So what tends to be a diversifier to equity? You say, okay, I've got private equity in my portfolio, I've got public equities in my portfolio, and generally you're going to invest in private equity, and we do this on our platform as well, double your money, 2 times MOIC at whatever IRR you want to put on the number. But if I said you could do a 2.0 MOIC at a 1% vol and zero correlation, you'd say, okay, well, what is that? I want to buy that. It's like core infrastructure, right? That's actually what it does. And how do you do that? You essentially do private equity, large cap, mid cap, doesn't really matter. You own a company outright, you manage it in perpetuity with strong cash flows. It has the inflation protection in it, oftentimes, because you think about a utility company. They have contracts with the government or based on regulation that actually allow those companies to pass on the input cost. Now, I don't like it in my heating bill, but it's at the end of the day, as an investor, you get to take advantage of that in a portfolio, which goes to pensioners, it goes to individuals. I mean, this is actually a good thing in a portfolio. You would do that all day long, and that's actually what real assets can do in a portfolio. They can give you income, they can give you equity returns, and they do it at 1 to 3% vol instead of 5 to call it 15% vol.
Great, thanks for that. I'm going to come back in a minute for a general question for all of you about volatility, because I think it is one of the question marks out there on private markets and whether it's measured correctly. But Benedetta, let me come to you. And I talked at the beginning about kind of retail investors now being offered increasingly access to private markets. And I think it's fair to say they are dramatically underweight in what any kind of portfolio theory would suggest is the right diversified portfolio. They've got next to nothing in private markets generally. I'm not talking about family offices here, but wealth management clients and retail. But that's all changing. And we're seeing this in the US, where products are now being offered. Now, I think you've got one or two things to say on this, and I know that that SSGA, you market products to both institutional and retail clients, and you're very well known in the retail space also. There are some concerns as to whether the right product is being pushed at retail who don't understand it might not be as liquid as they're used to in public markets. So sort of help us try and understand that and why this phenomenon is now growing, that people are wanting to sell this to retail.
Yeah, so, well, we have seen the growth of this industry to the numbers that you pointed out, Jack. It was primarily fueled by institutional investors, right? If you look at this industry in 5 years, 22% will be individual investors, right? So 26 trillion, 22%, 5 years. It's like 3 trillion of AUM that all of us asset managers want to be able to grab somehow, right? This individual investor opportunity. Why is there? It's very simple. You said it. This industry has been delivering higher performance. Take US buyouts versus S&P 500 for private equity. The same applies to MSCI versus European buyouts, but also the diversification that it provides, right? If you look at listed companies on US stock markets, they have decreased by over 43% over the past 25 years, which means that you will always have a better diversification if you build up a portfolio of private companies. So it's fair that individual investors want to get a share of this pie. Now, do funds that are targeted to institutional investors respond to the needs of the retail investors? I don't think so. And that's why you have to create completely different products. Generally speaking, I mean, retail investors have a number of requirements. 2 of them are higher diversification with respect to institutional investors. And you said it, liquidity. Mm-hmm. They do not really understand that duration of a portfolio, that illiquidity requirement that this asset class has as its DNA, right? We know that a private equity fund, considering extensions, considering continuation vehicles, is like 20 years of your money stuck, 15 to 20 years, depending on the extensions and the number of continuation vehicles. Retail investors are not up to that, right? So you create products that serve different needs, and for that specific reason, they end up having different returns, completely different returns, risk-return profiles. SSGA has done it. Obviously that we are a public house, and we were the creator of the first ever ETF. So it's not by surprise that we came to the market with a strategy that combines investment-grade public credit and private credit in the most quintessential daily liquidity wrapper, which is an ETF. Is that a substitution for private credit? No. It is a different product with a different risk-return profile, which could be a substitution to your fixed income allocation to get a little bit of private credit and get a little bit of that extra return. And we are leveraging on that trend, on the convergence of public and private markets, to create new products to individual investors. But again, they are not substitute to pure private markets, and that's a very important thing to remember.
Yeah, so not apples for apples, but at least giving retail investors access to really what are interesting opportunities.
Exactly.
So, I mean, I imagine as this continues, we will continue to see headlines in the papers, just as we did in the FT today, which sort of suggests and asks the question, are these the right products, or can they produce returns because they have to carry so much cash for liquidity purposes? But we'll see how this all pans out. Actually, just while I've got you there before I move back, you're in Dubai.
Yes, I am.
You're head of private markets for State Street in EMEA. Is this anything to do with diversification?
Definitely does. I mean, obviously, geographical diversification is a big part of diversification. We have to admit, sad reality check, private markets are not a global industry, right? Even if you pick the most global private equity fund, they will most likely have up to 30% outside Europe and the US or North America in general. That's not an international strategy. That's not a global strategy. I've been personally a very strong advocate of the internationalization of private markets. I've been covering the region for the past 5 years. Before I was doing it in a fly-in, fly-out mode. But SSGA has taken a very, very strong commitment to the Middle East. It's one of our growth pillars. We've been in the region since 1991, so one of the very, very first asset managers in the region, 4 offices and 80 people. So, of course, it's a way for me, heading private markets, to be closer, not only to the investors, but also to the ecosystem, because the Middle East has been an LP, obviously, market with some of the richest sovereign wealth funds in the world backing private markets, but it's becoming an investment ecosystem, and that's the reason why I'm based there.
Good. Well, it's the birthplace of AIM Summit. Now, before we finish, what I want to really challenge you all on, and one of the luminaries in the hedge fund world, I'm not necessarily going to name him, just used the term volatility laundering when it came to private markets. Suggesting, I think he's perhaps a little bit jealous, because when you're in the public markets and you have to do daily mark-to-markets, that's what you do, and the performance of your funds can look rather more volatile than perhaps those in the private markets. Now, this is important because I think volatility by many is considered an essential input into asset allocation models for portfolios. And so one suggestion is that because of the lower volatility of reported private market returns, is much lower than that in public markets, and it's put into the model, that it's really kind of overstating the diversity benefits of private markets and the lack of, and understating the lack of correlation. I wonder if any of you got any comments on that, because it is something that has been frequently leveled at the private markets industry, that it's actually more volatile than you think, or should be reporting a higher volatility than it does. Akhilan,
yeah, I can start. I mean, private equity is driven by operating performance. I mean, we at StepStone, I think, are fairly lucky in that we've got what we think is one of the largest private markets databases globally, where we have data on over 250,000 investments. What I would say is that, the value creation drivers in private equity have changed dramatically over the last 20 years or so, and they become, in many ways, less volatile, purely from an operational perspective. The drivers of returns being predominantly leverage of 20 years ago are no longer really as prominent these days. And I think many people in the public markets will poke holes at private equity in terms of the management fees that are paid to these managers. But I think what we've seen is that GPs have, if anything, overinvested in their operational value creation and capabilities. And actually, a much higher proportion of value creation is driven by EBITDA growth. Incidentally, in our co-investment portfolio, 90% of value creation has been driven by EBITDA growth. So I would just point to the operational value creation that you see in the private markets, but also poke back and sort of question the diversification impact of, quarterly reporting. The fact that private equity firms report on a quarterly basis is really probably the most realistic way of reporting. I don't think that can change.
No. And we've got, well, about a minute left, let's call it. Brandon and Suzana, how would you add to that? And how would you push back on this suggestion that kind of volatility is being smoothed in such a way that it misrepresents the value proposition, the diversification benefits of private markets?
Yeah, so it's actually quite a good point, and we are seeing that, in the last few weeks. So volatility really lends itself very well to private credit, where borrowers and sponsors are looking for certainty and flexibility of execution. That's when private credit really thrives. So if you have a limited legacy portfolio, dry powder, if you have, if you focus on diligent underwriting, you should be very well positioned in volatile, uncertain times as a private credit manager to achieve attractive risk-adjusted returns.
Brilliant.
Yeah, and the way I would answer it is at the end of the day, private market transactions, if you think about like what is actually occurring, a transaction generally is a bilateral arrangement. And so you're trying to mark to market to what you think a bilateral arrangement would be. And so you take the time in your valuation to think about your DCF, your multiple, whatever it is that you're doing in order to value that asset. So whether you report it monthly or whatever frequency you happen to do the valuation, it has the effect potentially of smoothing out volatility. But ultimately, it's because you can actually take a step back, and instead of responding to a tweet, you can just say, hey, you know what, it's actually, nothing has fundamentally changed about a particular company, so why market differently, right? So it happens to be the case mathematically that if the reporting cycle is different, you might end up with lower volatility, but the fundamental structure of volatility itself is also following that, because we're not going to change our valuation about a building just because something, happens to be hearsay in the news or whatever else it is, which you can do that because of liquidity in the public market. So I frankly think it's a benefit from a fundamental perspective and not just a reporting perspective.
Brilliant. Takes the worry out of it. Excellent. We are now completely out of time, so I'm going to have to say thank you very much, A, for attending, but most importantly to my great panel, and please give them a round of applause. Thank you.